Hello everyone. My name is Kamal Manocha. Today, again there's a Friday and we have another webinar planned for today. Last 10 years, we all of us have seen, if I'm talking about the last decade from year 2010 to 2020, when actually large caps outperformed mid caps and small caps. Last 10 years was the era of high liquidity and relatively lower growth. There were too much risk aversion, and maybe that is why large cap in terms of valuations went up quite a bit, and mid and small caps in terms of valuations have relatively left behind. If we were to see the returns over last 5 years, say from 2017 till date, the absolute returns given by large caps is around 55 to 60%, and mid caps is half of that, and small caps is even half of that. So why I am sharing all this is because today I am reminded of that saying that small things, great things come in small packages. And today we are going to talk about this in the context of mid and small caps with a fund manager who for last more than 13 years has been running a large cap biased PMS and very successfully managing that, giving around 19 to 20% CAGR and having delivered 9 times wealth creation, over his history. He brings with him more than 2.5 decades of experience, has been awarded multiple times. We, as one of the very well-known platforms in the space of alternates, have also kind of given him awards for 2 consecutive years for having done really well on long-term wealth creation basis. These awards were done in 2020 and 2021. Now, in front of us, there is new era, there is new decade where liquidity is drying and growth is back. The risk aversion, the mood, has totally gone diagonally opposite from risk aversion to higher risk appetite because everybody is bullish about India's economy. And in this, dynamically, I would say opposite environment, the same fund manager who has been managing a large cap bias multi-cap strategy has been successfully kind of and very, very hopefully working towards making his mid cap and small cap focus PMS a similar success over this decade. This PMS was started 1 year ago, and for last 1 year, the returns have been on number one. The PMS has generated 20% returns, on last 1 year basis since its inception, versus the respective benchmark having delivered around 6 to 7% returns. So obviously, all these things pulled us to go back to this fund manager. I am just going to share his name, Mr. Rajesh Kothari, who is the founder of AAA, AlfAccurate Advisors. So today we want to understand from him, though he has been successfully managing a flexi cap scheme over last decade, what happened and why is it that now, suddenly he's so bullish about managing a mid and small cap PMS, and why, what is the genesis of that thought process? And then in due course, we'll also understand, what is that secret sauce that he has to kind of express today that is giving him so much confidence in terms of creating maybe wealth creation that we today are calling that all great things come in small packages. And that is how we have named this webinar as a tool to create wealth creation through emerging giants. Welcome to this webinar, Rajesh. And before kind of we formally begin conversation on some of the technical aspects of your product, I want you to tell us, to our audience today, what are your views and thought process broadly on, say, next 5 years in terms of India's economy, in terms of market caps, and why have you kind of today focused more on mid and small cap space?
Great, Kamal. So first of all, thank you very much for giving us an opportunity once again to be on this webinar. I think probably we have done many webinars together in last 2.5 years, and I must compliment you, Kamal, for doing a wonderful job for investors by creating a platform for PMS AIF. All PMS AIF put together, and I think it is a fantastic job what you guys are doing over there. Coming to your question, and it's a very interesting question. If you ask my personal view, I never believed in any thesis. No thematic products has worked in the world in last 30 years, 50 years, 100 years. And no thematic product has worked in India as well since last 40 years. Okay. Thematic products means when a theme does well, the product does well, and every theme is a cycle. When the theme ends, the product returns also comes down. And it's very difficult for investor to time the theme. Extremely difficult, extreme possible. And therefore, we have been and always, even today, are averse to launching any thematic product. We always believe in launching a structural products. When I say structural, it has to be 10-year story. It cannot be 3 months, 1 year, or 3-year story. It has to be minimum 1 decade. That's what always we believe in. So why we launch emerging giants? Well, as you rightly mentioned, we already have our AAA India Opportunity PMS plan. It's the multi-cap PMS plan with 50% large cap and 50% mid cap and small cap that we have been managing from last 13 years. In 2018, the regulator came out with a new regulation whereby for the first time they defined the market cap, and based on market cap they defined the categories. So first 0 to 100 is large cap, 100 to 250 is mid cap, and anything beyond 250 is a small cap. And when we further analyze the corporate India data, we realize that this is going to be a big opportunity for investors, because in India, there are 5,000 listed companies. And out of 5,000 listed companies, there are only 550 companies, that is just 10% of the universe, which makes net profit in excess of 100 crores. Just 550 companies. Hypothetically, let me give one example. If a company is, let's assume, is a 100 crore profit making company, it means it is India's top 550 company by net profit. Let's assume you give him a PE of 20 times, then the market cap of that company is 2,000 crores. But it is considered as a small cap because the 250th company market, below which everything is a small cap, is roughly about 15,000 crores. The mid cap, the new definition. And that's the reason why we thought it is prudent to launch AAA emerging giants, which will primarily cater to mid cap and small cap of the new definition by the regulator. And that's the reason why we launched AAA emerging giants. One important thing which I would like to highlight you is that, as you are aware, we follow 3M investment approach: market size, market share, and margin of safety. And we buy only market leaders. We have not made any compromise on that investment framework. Probably AAA emerging giants is probably only plan, or might be one of the few plan in the country in mid cap and small cap, which does not invest in any mid profit size company or small profit size companies. It invests only in market leaders. It invests in only in those companies whose profits are 100 crores or will become 100 crores in 12 months or so. So companies are large. And that's the reason why the name of this PMS is emerging giants. Why giants? Because they are already leaders. They are not emerging leaders. Let me tell you categorically, all these companies, they are not emerging leaders. They are already leaders. And we believe that they are now taking next step forward to become a giant. And that's why the name of theme is emerging giants.
Sure, Rajesh. So, because this is the space of mid and small cap, we would want to first understand from you what is the investment philosophy? How do you identify these companies? What is the approach? Because the universe is quite broad, as you yourself mentioned. What differentiation you bring on the table? And obviously, having more than 1 decade of experience, particularly managing public money, and more than 2.5 years of experience into the equity markets, now particularly into mid and small cap space, I'm sure you would have devised a ideology and philosophy and approach to obviously ensure that there are no accidents. Obviously, one cannot avoid accidents, but what is that ideology and process that you have, or you may call it investment philosophy, that we want to understand to begin with?
Very good question, Kamal. Our investment philosophy at AlfAccurate Advisors, irrespective of the product, is protect capital, create wealth. And that is our investment philosophy, irrespective of which product it is going to be. Particularly what happens when you talk about mid cap and small cap to any investor, the investor is always a little bit fearful because by definition it is a more risky, correct? But there is a way to reduce that risk. And that's exactly what we have done in our AAA emerging giants. When you buy a small company with a net profit of 10 crores, 20 crores, 30 crores, definitely you are taking disproportional risk. When you buy a company which a 5% market share with a hope, and that story, इंडिया में स्टोरीज होती है कि भैया ये 10 साल में ये 5% मार्केट शेयर 50% हो जाएगा, लेकिन एक्चुअली रियलिटी में ऐसा होता है बहुत कम कंपनी से आगे जाता है. इट्स अ वेरी एक्सेप्शनल केसेस where such stories happen, but 99% of such stories, they generally don't fructify. So what we have decided is that first, we will not buy any company with a net profit of less than 50 crores. Very important. Most of the portfolio companies in this plan has already completed 1.5 years. Almost 95% of the portfolio companies, they own 100 crores plus net profit. It means they are India's top 500 companies by profit making. Number one. Second important risk is, are you buying a small company by market share? Because moment you buy a small company by market share, we believe that it is going to be against you, because big is going to become bigger and small is going to become smaller. All our portfolio companies, they are market leaders in their respective segments. In fact, what we have done, Kamal, is that we have identified about 30 sectors in this space where there are only handful of players. Let me give you examples. Plywood industry, there are only 2 companies. And I would also first like to put disclaimer that whatever companies we are going to discuss is just for academic purpose, and we might have portfolio positions for these companies personally or for our clients. Coming back to examples, say plywood industry, there are only 2 players, Century Ply and Green Ply. There is no third national player, but Century Ply is considered as a small cap. In luggage industry, there are only 2 players, VIP and Safari, but Safari is considered as a small cap. India's largest mall, everybody knows the company which is listed with a mall presence across the country is called Phoenix Mill, is a mid cap. It's not a large cap, because market cap is below SEBI's definition of large cap. It is not among top 100 companies. It falls after 100 companies. So it's considered as a mid cap. India's largest pump manufacturing company, the third largest pump manufacturing company, German subsidiary, is a small cap. Company is not small. Market cap is small. India's largest tiles company is a mid cap. Company is not mid-size. It's the largest company in tiles industry, but defined by regulator as a mid cap. And so on and so forth. I can give you so many examples. Look at bearings. There are only 3 companies in India, and all these 3 companies are either small cap or mid cap. Timken, Schaeffler, and SKF, all of them are either small cap or mid cap. Or India's largest company in fasteners, like Sundaram Fastener, is a small cap. Or India's largest company in shock absorber. There are only 3 companies in shock absorber. Gabriel is one of the largest company. Is considered as a small cap. Amines, Balaji Amines, for example, is considered as a small cap. There are only 2 companies in India. So what I'm trying to drive home is, if you can reduce the underlying volatility of mid cap and small cap, and that you can reduce only and only by buying the sectoral leaders. And once you buy the sectoral leaders, you are inherently reducing the risk within mid cap and small cap space. That's one way of reducing risk through the right stock selection. Second very important way, Kamal, and I'm sure you know about our investment philosophy, diversification is the only free lunch in equity market. There is no other free lunch in equity market. Only free lunch is diversification. We are pioneer of diversified portfolio in our multi-cap PMS. Triple IOP is a 13 years. Only portfolio in India with a 50 stocks portfolio launched in 2009. Same strategy we have continued over here. It is a mid and small cap emerging giant, is also a 50 stocks portfolio. That also reduces the underlying risk, company specific risk, sector specific risk, management specific risk, volatility risk, all that risk also reduces. And third most important is, do not stop buying the best businesses, but monitor them on diligent basis and use your discipline exit strategy whenever you think companies are not going to meet your expectations or when the valuations are fully reached. So that's the mechanism of our investment philosophy. protect capital through DSD approach, diversification, staggered investment, and disciplined exit strategy, and create wealth using 3M investment approach: market size, market share, and margin of safety. All our companies in our triple emerging giants, they all are market leaders. Most of the companies in our emerging giants, they are a debt-free balance sheet. Think of a deadly combination. You are a market leader and you have a debt-free balance sheet with a high return on net worth and of course, very strong earnings growth. That's the investment philosophy for triple emerging giants.
Sure, Rajesh. So within the mid and small cap space, we have seen there is always a cycle that follows. We saw 2017 was one year when mid and small caps had actually outperformed and they gave very good returns. Then after that was year 2021. Now, many investors have this apprehension. They feel that 2021 was one year where mid and small caps have done really well. And maybe, this cycle will again play where we will see a correction happening first in large cap and then in mid cap, and mid and small cap will correct more than large caps. So maybe, at such a time, which we are seeing currently where world is going through macro, I would say, issues, mid and small cap is a space which seems to be very high on risk. Though obviously from domestic, story perspective, if we were to believe in the growth story to continue, one kind of can argue and say that mid and small cap is the way forward. But if you were to address this particular concern in terms of the levels, in terms of the cycle, how would you kind of answer this particular question?
See, Kamal, very important is that there is no market cap which is a permanent best performer. If suppose somebody who invested in large cap only, or in mid cap only, or small cap only, one particular year might be great year, one particular year will be probably the worst year, and 2 to 3 years are neutral years. That's the range. That's why we always say invest for a period of 5 years. That has happened in large cap also. It has happened in mid cap also. It has happened in small cap also. But having said that, very important point what you have raised is why mid and small cap primarily people have that fear, because they are more volatile and therefore drawdowns at times are very high. And that high drawdowns results into high fear in minds of investors. Now, that's what exactly I'm saying. How to reduce the drawdown. As a fund manager, what is in your hand? As a fund manager, what we make sure is to make sure that you invest in companies which are not small companies. Please remember, there are two different things we are talking. One is market cap, mid and small cap. Other is companies are mid and small companies. We do not invest in mid and small companies by profit size. For example, Trend is the largest retailer in the country. Safari is the second largest luggage player in the country. Gabriel is the largest shock absorber player in the country. Century Plywood is the largest plywood player in the company. All these companies I am holding in my portfolio. Schaeffler is the largest bearing company in the country. Now, if you think that car industry is going to do well, then Gabriel has to do well. If you think consumer discretionary, the formalization, the urbanization is going to increase over the next 3-5 years, Trend has to be the best performer, and so on and so forth. So you can reduce this inherent volatility. You started with the opening remark, and thank you for that remark that, we have done 20% returns compared to benchmark returns of about 6-7%. Despite Russia-Ukraine war, despite supply chain crisis. Why? And do you know the reason behind it? The reason is our company's portfolio earnings growth is 30% plus. I repeat, our portfolio company's earnings growth is 30% plus compared to Nifty earnings growth of 14%. But what makes our companies to grow at 30%? Because they are market leaders. And if you buy market leaders, you are inherently reducing your risk. So you don't need to worry about whether mid cap will do well, or whether small cap will do well, or whether large cap will do well. All you need to think about is that, do you think India's top 500 companies, do you think the leader of every segment of Indian industry will do better than number 10 and number 11 player? If answer to that question is yes, then our product will continue to do well, irrespective of what happens to the overall mid-cap and small-cap space in the medium to long term. I hope that answers your question.
Bang on. Quite convincing argument. So moving on to, next subsequent question that comes to my mind. So some of these names that you have taken are all market leaders. And if they are so, and obviously, we believe in that, what is the kind of overall valuation of the portfolio? Because if they are market leaders, it is well known to everyone. And hence the price is already kind of, incorporating the entire, I would say, attribute of it being a market leader, and hence the foreseeable, I would say, future of that. So in that context, your portfolio obviously, is a growth style of investing, but within that growth style of investing, we would want to understand whether the return is going to come primarily because of the increase in the earnings, or there is a possibility of price also getting re-rated over a period of time. Because if one is taking risk of investing into a portfolio of mid and small caps, maybe not by profit size but by market cap size. So we want to understand what are the kind of expectations one should keep in terms of volatility, in terms of underlying valuations, in terms of number of stocks, in terms of expected returns. So if you could throw some light on these factors, that will obviously kind of make the argument further strong.
Good questions. Valuations is a one very important aspect for us in our 3M investment approach: market size, market share, and third M is margin of safety. The margin of safety is nothing but the valuations. How to determine what is the right price you are paying for the stock which you are buying into? Clearly, one thing is clear. If you want to buy a company with an oligopolistic or monopolistic kind of a positioning, if you want to buy a company with 100 crore plus net profit size, if you want to buy a company with a zero debt on the balance sheet, no long-term loan, no short-term loan, no overdraft, is a big statement I'm talking about. If you want to buy a company with an operating cash flow above 70 to 100%, and if you want to buy a company which is growing earnings by 20 to 30% per annum, definitely if you are going to Taj to have a cup of tea, you have to pay Taj price. The question is it a right price? Is it right value for money or not? Correct? So if you buy fourth grade, third grade quality management, you may get deceived by the 5 PE stocks. But 5 PE can only become 6 PE at max. Earnings may not come at all. Correct? So I think very important is to look at the PEG ratio, price to earning growth ratio, along with return on net worth, along with the pristine balance sheet status. Of course, the corporate governance and the leadership is something very, very important. Since most of the companies in our portfolio are market leaders, they are backed by the best of the management, best of the corporate governance, and best of the financials. Let me give you one example. And I remember one of my friends, he asked me, I think few months back, looking at Trent in my emerging giants, Rajesh, don't you think Trent is hyperly overvalued? Trading at roughly 75 times price to earning multiple. Just one example I would like to share. And I said, do you know, sir, there is a company called Zara, Inditex, Global. Do you know at what valuation it trades at? He said, no, I don't know. I said, it trades at 36 times price to earning multiple. But do you know what is the growth of Zara, Inditex, for next 5 years? The growth is likely to be 3%. Revenue growth I am talking about. 3% revenue growth story, but largest, one of the most respected and probably one of the most profitable company in the world, Inditex, 3% revenue growth, and you pay 35 times price to earning multiple. Now let me compare Trend in front of this. I don't know how many people are aware. Trend, we all know, this is well known by Westside. In March 2018, Westside had roughly 1.7 million square feet under its belt. But I don't know how many people are aware that Trend has created another Westside in the Trend by launching a format called Zudio. And in a matter of just 3.5, 4 years, today, Zudio has 1.6 million square feet under its belt. If you bought one trend 4 years back, that time it was trading at 90p, by the way, you got another trend free because Zudio is now equivalent to Westside. You know what I'm trying to say? So what is important is what valuation you are paying for what kind of a sustainable earnings growth for next 3 to 4 years. And that's how you need to evaluate the business opportunities, and you have to evaluate what kind of growth, whether the company has an ability to become a multi-bagger. You know, people say, multi-bagger आप कैसे identify करते हो? So, of course, when we buy, we don't know ये multi-bagger होएगा कि नहीं होएगा. I wish हमें मालूम होता. वो तो मालूम होता नहीं है. But when you buy the company, you know whether company has an ability to create another company within the company equivalent to the size of the company. You know, this is something very important, because if a company can do that repetitively every 5 years, then every 4 years, company can double its profit. And if the company profit can double in 4 years, even if you do not assume any PE re-rating, the stock price normally in the long term mirrors the earnings growth. Does it answer your question?
Yeah, absolutely, it does answer. But it strikes a subsequent question in mind. If I put myself in investor's shoe, who is wanting to evaluate, your AAA emerging giants portfolio now, that to take example of trend, this story has now played. So when any investor
Beginning. This story is beginning. 1.6 million square feet I talked about Westside. 1.8 million square feet I talked about Zudio. That is right now already in last 4 years. 4 years back पहले भी किसी ने सोचा था ये तो स्टोरी हो गया और कंपनी ने Zudio खड़ा कर दिया. Now that 3 million square feet today is likely to become 6 million square feet in another 3.5 years. So ये तो beginning है. Why? Because in India, if you look at the trend, you look at Zudio, look at Westside, what is the presence? Presence is the apparel segment, right? That's the biggest segment, is the apparel segment. And वहां पे unorganized sector is probably 75-80% of the industry. Correct? So this company has a roadmap to grow at 20-25% compounded for another probably at least 5 to 10 years. I don't know after 10 years what, And I'm sure, Kamal, you know that in India, the FMCG companies with a pathetic high single-digit earnings growth are trading at 85 PE from last 6 years. Whereas I'm talking about a consumer company growing at 25% compounded for next 5 years, definitely it will command similar valuation like a consumer company in FMCG, if not higher, because growth is significantly higher. That's basically the difference. When you look at the future, you need to decide what are the building blocks in place for this company. Are they first? Are they fast? Are they agile? Are they technology savvy? Do they have the right management bandwidth? Today, how many retail apparel companies you can think about which are agile, can move fast, and which can do the consumer rising aspirations of Indian customers at an affordable price in an organized sector? How many? Not many. Maybe one, maybe two, at max 3 players. I don't know who is third, to be very frank. Only 2 brands. But the presence of trend is across the apparel. It is not only formal menswear. It is not only 3 brands. It is across. And it's a private label. Most of them are 95% is private label, which is not the case with many other departmental stores like Shoppers. That's not private label. So it is not a comparison at all. Right? How many players you can think of? In India, there are only 2 players. It's a 3 players market. That's it. Entire 95% is unorganized. You have a huge roadmap for growth, huge runway for growth. So, I'm not worried about it. Beyond a point, I think what is important to understand is whether the company has a, highway for growth or not. Balance sheet is pristine. As I mentioned, management is great. ROE, ROC, everything comes in line because in retail, so entire fixed cost becomes, fixed cost remains fixed. That's basically how you need to analyze any company, whether it is a retail. I can give you many more examples. Like, for example, I have one company called Minda Industries. This company has grown its revenue by 7 times and profit by 10 times in last 10 years. Every time people ask, what next? I remember 4 years back when I bought Minda Industry in my IOP, people asked, don't you think it's expensive? What next? I said, you will see what next, don't worry. And they became the largest player in alloy wheel. Today, they have become the largest player in seats. They didn't have a seat presence 4 years back. But today, they are largest player in seats. Earlier, they were only into two-wheeler horns. But today, they are largest in seats. Today, they are largest in other 3 segments. They are largest in alloy wheels. Today, they are largest in airbags. I don't know whether you are aware, the company has made a tie-up with a company called Fideco for EV. The current content per vehicle is 8,000 rupees, which they can address. By a joint venture tie-up with that company, they can now address 56,000 rupees content per vehicle. We are talking about an 8x opportunity. I'm not saying they will get entire 56,000 rupees kitty from the customer, but that's the addressable opportunity because of one solid joint venture technology tie-up. 8 times. That's huge. When Indian economy is growing at 10-11% in nominal terms, if you can identify the businesses which can grow at 18, 20%, 25% over next 3 to 5 years, that's the opportunity what emerging giants brings on the table.
Sure, Rajesh. So, obviously, we cannot discuss all of these stocks. And to audience out here, I would like to give one disclaimer that whatever stocks we're discussing, this is only for education purposes. Obviously, Rajesh has already acknowledged that all these stocks are part of his portfolio, and this is not to be construed as any kind of advice. We are just, discussing them to kind of understand it more academically. Now, more to understand that how have you identified some of these companies. So I'm sure there is an approach that you follow. Is it top down approach or bottom up approach, in terms of first having a view on a sector like you talked about EV. We have been hearing similar, fund managers like you with great history and great track record talking about manufacturing sector as, one of the stories which is expected to play or maybe continue to play well over next 3 to 5 years. And so in that regards, I want to understand from you today, if you have, say, 30 to 40 companies in your portfolio, what is the kind of sector allocation and how have you identified them, and how will you eventually, kind of over a period of time evaluate that and review that and kind of, realign that to the forthcoming environment?
Good question, Kamal. As I speak with you, our largest holding right now is in consumer segment, which is 27% of the portfolio. Capital goods, we were the probably early one in identifying capital goods as a theme. Right now, we are holding roughly 20% of the portfolio. Specialty chemical is always close to our hearts. We know this probably, we developed a little bit early more advantage, know the industry well, and currently roughly about 11% of our triple emerging giants. Banking and finance is roughly 14% of emerging giants, and automobile and auto ancillary roughly 9% of emerging giants. So that's first answer, sectoral allocation, how it looks like. Second question was how we identify this. There are a number of ways and it will be difficult to put it in one line, but we follow top-down and bottom-up approach. What is your top-down approach? Market size of the opportunity should be large. Market share, company should be top 5 player in the industry. Very important. Company should be top 5 player in the industry. That's one way. Then there is a second way. What is the company's profit size and company's underlying balance sheet and company's underlying return on net worth. So avoid any companies with more than one time debt. In fact, all my portfolio companies are debt free. 95% of the companies are debt free. Underlying business return on net worth should be 15% plus. So that is another way of filtering. So you keep reducing your companies which you want to target. And third is then you put the top-down approach and bottom-up approach, that which are the companies which you think are ready to capitalize on the growth opportunity. India is a big growth market. And if you can identify the companies with the right levers of growth, a companies which have a hunger to grow impassionately, then you have a huge scope for identifying the best of the management. Like I mentioned, Specialty chemical, we know this industry well. We've been early entered, we've been investing since last 5 years. So we know what are the things which are happening. When government announced PLI and when China plus one was happening, it was obvious that specialty chemical being the one of the very domain country, we are domain in chemistry, will definitely become the biggest beneficiary of this industry. Specialty chemical is going to be the biggest beneficiary. And then within that, for example, we bought a company which is a 65% market share in the world. I keep talking about India leader, now I'm talking about world leader, and still it is a small cap. And we bought that company in our portfolio because that company is a 65% market share in the world, and that company has done capital expenditure, significant capital expenditure, expanded its capacity by 20, 30, 40, 50%, and further likely to make capex to grow consistently another for 30, 40, 50%, from here on I'm talking about. So likewise, then we identify the business. I also talked about how we identify companies by looking at the company's capability to add a business size of the current company. For example, let me give you one example. Schaeffler, the top 3 bearing company in the country and in the world. The exports revenue of Schaeffler 5 years back was roughly about 3%. Today, it is roughly about 18%. From 3% to 18%, exports revenue have become almost 3 times. Can this 18 can become 25, 30? Maybe yes, maybe not. But that's the opportunity. So on domestic side, you will definitely get benefit of the domestic economy growth. You are a market leader, so you will also get benefit of that. People are doing China plus one, so you will also get benefit of that. You are doing capital expenditure expansion program to cater to the change in the domestic requirement because more metro railways are going to come. So your high value added bearings will come. That is a natural advantage. But on top of it, Schaeffler will also benefit from its parent company's decision to source more and more from Schaeffler India. They have made a capital expenditure of 1,000 crores, out of which, if I'm not wrong, 400 crores already done. 400 crores they will do it in current year and another 200 crores next year. 1,000 crores capex can potentially give you maybe 2.5 times revenue. So roughly about 2,500 crores revenue will be added. Good part of it will be for the export market. Good part of it will be for the EV type of products, because industry is moving to EV in automobile. So who will able to manufacture the right products for such EV automobile companies globally? Schaefflers of the world. And look at now. It is now China plus one was yesterday's story. Today it has become Europe plus one. Schaeffler is a European company. And because of the higher energy cost, European plants are under problem. Schaeffler India will be a natural choice. I don't know if that happened or not, but definitely it is going to be a natural choice for any company in the world. So if I'm a parent company sitting in Europe, and if one of my plant is facing problem, what I will do? I will call up my subsidiary, wherever it is, and tell them, hey, can you supply me XYZ? So it's a natural advantage. It's a further acceleration of the growth. That's how we identify the growth opportunity across the different segments.
Sure. So I think, we have covered about your emerging giants PMS, quite, I'm sure, at length. And audience out here, obviously, my kind of request to everyone, if you have any questions particular to this strategy, you can kindly type in and we will cover those questions. Second part of this webinar, we would like to cover more on markets and views, that Rajesh and AlfAccurate advisors wants to convey about economy and markets, because obviously, markets are going through a volatile times. We have seen, equity markets going through a corrective phase over last almost 12 months. Correction started September 2021, and by end of this month it's already more than 12 months. And if I was to kind of remember history of last 22 years of equity markets, which is my career, I have not seen equity markets actually remaining in consolidation phase for more than 14-16 months. So that kind of makes me believe that maybe we are kind of maybe close to bottoming out very soon. But I would want to get this view validated from Rajesh, and obviously in that context, what are your views? Because on one side we understand we are believers in long-term equity markets, and we see that pessimism is gradually getting incorporated and it is kind of behind us. But on the other side, the way interest rates are rising and the way obviously inflation is risk which is coming, especially towards West, they are seeing inflation for the first time, and eventually that is leading to a lot of stress to currency, a lot of stress in terms of liquidity, and all these macro risks seem to be new risks, and hence investors are kind of worried. And at the same time, investors today, most of them are already invested in equity because last 2 years were very good for equity markets, so they want to understand what are the broader views over next say 1 year about equity markets.
Well, Kamal, I think it is a foregone conclusion that global countries are under their own problems. Definitely, they are under weather. US is recession. I think the word recession is one of the most searched word in Google. China is having its own problem. They are facing slowdown. Japan is in recession for the last 30 years. Europe, वो तो ऐसे भी बेचारा बन गया. They are in their own crisis. Without any reason, they became the unfortunate kid who is suffering a lot because of Russia, Ukraine. When we are talking about recession, it means we are talking about demand slowdown. How can inflation remain so high? How can interest rate remain so high? It can't. Either we should say that demand is going to be buoyant and therefore inflation will remain high and therefore interest rate will remain high. Demand has never been buoyant. It was a supply chain crisis. It was a geopolitical crisis which resulted into non-availability of goods, resulting into advance ordering of the goods, because everybody wants to make panic. Nobody wants to have that, I don't have milk in my home. Suppose somebody announced tomorrow that milk will not be available. No, अभी भी आज भी होता है, बॉम्बे दिल्ली में भी होता रहेगा, आई एम श्योर, कि अगर आपको नोटिस मिलती है कि म्युनिसिपैलिटी विल नॉट, ड्यू टू सम टेक्निकल प्रॉब्लम, they will not give you water for 4 hours. What we all do? We do storage of 5 buckets. Do we need 5 buckets? May not be. We probably need only 3 buckets. लेकिन हम 5 bucket भर के रख देते. Contingency plan. In COVID, everybody did that contingency plan. The supply chain crashed. And because of that, inflation went up. And because of that, interest rate goes up. But we are talking about a world slowdown. Europe, Japan and China तो already slowdown mode में है. बचा एक अकेला US है. उसमें भी वो लोग तो बता ही रहे हैं कि भाई हमारा डिमांड भी नीचे जाना ही है, वो निश्चित है. Can this inflation, can this interest rate, can it remain high beyond a particular time frame? Yes, right now it is a problem. It is a discounted problem. Everybody has talked enough about it. 4.5% interest rate in US. Everybody has discussed. Most of the global research firms has written about it. Fed has projected about it. But what next? What next? Markets are always ahead of time. Markets are never rearview mirror driving. In last 42 years, US economy registered degrowth in GDP 2 times. But Kamal, you'll be surprised to know that in both those years, where GDP was negative, S&P 500 went up by 15%. Why? Because markets are always ahead of time. And this time, it is not going to be different. So yes, volatility will remain high. We'll keep seeing this bouts of volatility. We don't need to change our plans because of volatility. It will change your mind. Look at today's market. Who thought market will be up 2%? 1000 point Sensex ऊपर है, 300 पॉइंट निफ्टी ऊपर है. आज किसने सोचा था? लोग बोल रहे थे हम स्टेगर करेंगे 3 दिन पहले, आज बोल रहे अरे कर देना चाहिए था. तो हम क्या करना चाहते हैं? Whether we want to time the market for 5% correction, you should assume when you invest in equity, 10% correction is given. If you think market can collapse by 30%, you should not invest right now. I don't think so. 10% correction is a normal correction, anytime correction in any equity market. Don't wait for the 10% correction, because as I said, India's top 500 companies, the companies which are market leaders, companies which are debt free, companies which have a capex plans, companies which are backed by great management, companies which are enjoying good corporate governance, these companies big will become bigger Big will not become smaller. Small guys with a high debt will be underwater. Companies with a not good succession planning, they will go underwater. They have to sell it out. They will go underwater. But companies with great management, right market leadership, capex expansion plan for growth, these companies have to grow in front of your eyes. Zudio has been created. Means हमें पता भी नहीं चला Zudio website जितना बड़ा हो गया. In front of your eyes, Avenue Demand has been created. And I think so many new companies will keep coming in and they will double and triple their size and quadruple their size in next 5-10 years in front of your eyes. This decade belongs to India, and I don't think we should waste this opportunity to create huge wealth. You know, in one of the conferences, I was talking with a very good, knowledgeable crowd, and I was telling them, ये परसेंटेज की बातें छोड़ो, कितना गुना कमाएंगे ना वो सोचना चालू करो. ये परसेंटेज की बातें छोड़ो. If you have a 10-20 years view, कितना गुना हम कमा सकते हैं. India has arrived. We are the fastest growing economy now in the world. 7% GDP growth. Look at our currency. Look at the resilience. कभी हुआ है ऐसा? अभी तक तो नहीं हुआ था. लेकिन आज देखो अपनी करेंसी की resilience देखो compared to any other emerging market. After probably Indonesia, we are the best performing market in the world. Despite FI selling crazily for 9 months. 9 महीना FI ने बेचने के बावजूद our markets is still the best performing market in the world. Can you imagine this? If I have told you on 31st December last year that in February Russia-Ukraine war will happen, in March crude oil will become 130, you would have sold off everything and would have gone on. But look at market. Nobody thought market will be this post Russia-Ukraine war, post crude becoming 130. That's the resilience of India. That's the opportunity of India. The world's problems, fortunately or unfortunately, has become India's opportunity. India is considered as a medical store for the world, for pharmacy. When world was under COVID, it was our IT engineers who made world continue to survive through cloud. And now it is going to be years of specialty chemical, where we have only 5% market share compared to China, 18% market share. Same thing will happen to capital goods. Same thing will happen in automobile components and many more such segments. And that will happen, again I repeat, in front of your eyes. Participate in the opportunity. Don't try to time 5 to 6% market correction. That's my personal view.
Sure. Your conviction all the more convinces me to, cut my check and give you to do my investments. Absolutely. And I come to, more from investor-centric questions. So, before picking some of these companies in your portfolio, what is the process you follow? Is it the evaluation done on paper, or you go out and meet these managements, or there are people in your team who do that for you and you rely on their research? How does that practically happen?
Well, of course, we have a big investment management team. We have a combined experience 75 plus 80 years now, combined experience at the team level. On an average, we meet one company a day, or maybe at least more than one. For example, today we already met one company, probably another one company we are meeting after this call. So before buying any company, we talk with the customer, we talk with the competitor, we talk with the supplier. Only when we get green signal from 180-degree due diligence, then we meet the company which is under evaluation. And only after we meet and do the cross-checking due diligence and get confirmation on how the growth will pan out, that's only when we buy the business. Otherwise, we don't buy the stock.
And the approach is model portfolio, or you create every portfolio uniquely depending upon the market environment?
Very good question. We are one of the only or one of the few PMS in the country who do not believe in model portfolio. We buy today what we like today. It is always a forward-looking portfolio and not the backward-looking portfolio.
Another important aspect is the fee structure. Can you please explain what are the fee structures that you follow in your AAA emerging giants PMS?
Basic industry, same structure like any other player in the industry. We have a 2 plans, fixed plan and profit sharing plan. Fixed plan is 2.5% fixed fees per annum. Profit sharing plan is 1.5% fixed fees, 20% profit sharing, 10% hurdle rate, exit load for 2% for first 12 months. After 12 months, no exit load. Very standard industry competitive. I mean, one can send email or they can touch base with you guys and you can guide them.
Sure. Can you spend maybe 2 minutes explaining what are the kind of number of clients that you have added over, say, last 13 years of a history, and total AUM that you manage, and this particular PMS that you have recently launched. What are similar attributes in terms of AUM, number of clients, and your plans, say, over next 3 years in terms of, because I have seen the larger the AUM gets, the slower the pace of alpha accretion happens. So in that context, we want to understand where do you stand, because particularly in the mid and small cap space, how do you want to kind of call your shots? Because there are some fund managers who do not call a shot and ultimately keep adding money, and beyond a point, obviously, it limits their performance. Investors are not aware of these technicals, but I want you to cover this aspect also.
Yeah, I think good observations, Kamal. So let me tell you, our overall size is roughly about 1,250 crores at the firm level, spread across 400 plus families, more folios, because in India there are multiple folios by one family. Triple Emerging Giants has been launched just 1.5 years back, to be precise, in January 2021. And when we launched this plan, in the next 2 months, market went up 11%, and pandemic wave 2 started, if you remember those days. So we closed the plan. We said we don't want to take any risk because markets are becoming uncertain. And only very recently, we reopened that PMS plan. We are very, very sensitive about when to take money from the investors. If there is uncertainty, we do not want to gather AUM. That we are very clear. That's why we closed the PMS actually during the pandemic wave 2, despite actually we didn't raise much money. It was just about 10, 12 crores or so. So our size is pretty small, as it has been reopened only recently. Size is roughly about 18, 20 crores or thereabout in Triple Emerging Giants. One important point also I would like to mention, that the observation what you mentioned, that in a mid and small cap, the size of AUM versus the return. As I'm saying, our portfolio, we do not own any small company. We own only big companies with market cap is small. So we do not have illiquid companies. We are absolutely against it. Correct? Our average weighted market cap is also very high compared to normally what you see into the typical mid cap and small cap fund. So from that perspective, it is a quite very, very resilient portfolio, and can have a significant, what I would say, capacity of as far as assets under management goes. So that's about Triple Emerging Giants. Kamal, are you there?
Sorry, I was on mute. So, one of the questions in the audience, someone has asked that when you do not follow a model portfolio approach, is there a way to kind of calculate or maybe anticipate the variance of one investor from the other investor, or how much time it takes for older investor to kind of converge with a new portfolio?
Good question. Very good question. Little bit technical question. I hope others also able to get this, the question as well as my answer. So what happens typically in a mutual fund or most other PMS, they have a model portfolio, and when new money comes, new money gets invested into the model portfolio. And to me, that's basically a big, what I would say, is not a right practice. So what we follow is completely different. On a daily basis, we create a model portfolio. So for example, today what I like, stock A, stock B, stock C, we create today's model portfolio, a new model portfolio. And on everyday basis, old keeps moving to new. Are you with me? I hope the person who is asked question is able to understand this. If not, probably we can do one-on-one call. So on everyday basis, the old keeps moving to the new portfolio, and therefore the portfolio basically gets aligned, but it's a reverse process, not the usual process. And by doing that, you are basically avoiding any biases. You are avoiding the cost column, because there are people who have a mentality that if I bought at 100, I cannot sell at 80. We don't have such bias. We don't have cost column, and by doing that, you make sure the variance, therefore, also by natural process is very, very low variance between best and the worst.
Sure. So we are coming, to the last question for this evening. So you have discussed, why it makes sense to invest in mid and small cap space over next, 5 year as a horizon, or maybe over next decade, and the kind of return expectations one should keep over, say, 1 or 2 decades, is not in percentage terms, but should be kind of one should be expecting to multiply one's wealth, obviously over a longer period of time, because we are in some of the best times as far as India's economic growth story is concerned. And that is the reason for you to kind of particularly get into this mid and small cap space. And within that, you are kind of participating with the approach of identifying market leaders in the respective sectors that you have highlighted. So obviously all this gives us comfort, and then because these are market leaders and not small companies and maybe large companies in terms of profitability, and portfolio is well diversified, given your more than a decade of experience in managing public money, we are quite kind of confident in terms of risk management that will actually be executed. However, one very important question, which is my personal question, because I'm seriously thinking of now kind of investing myself into this portfolio because I have a long term horizon, is that what is the exit strategy? Because I have seen many great fund managers have also done mistakes in exiting some of the very good stocks at wrong times. It happened during COVID period, it happened during global financial crisis. I have been working in these equity markets for last 2 decades. So exit strategy is something which now today, when you very confidently talked about specialty chemicals or retail story like Trent and all, right? So obviously these sectors and these stories, at some point of time, one will have to identify how and when to exit. If you identify this late in cycle, then obviously it will pinch investors, and those investors who will enter at that point of time will feel that I just entered and my first 1 or 2 years I have to see losses. So I'm sure there is a way out to avoid all that, but all these things are not in entirely in your control. However, there has to be some mechanism. There has to be some learnings from your 1 decade of experience. So maybe you take 5 minutes, 10 minutes, but we want to kind of understand the entire exit strategy. How does it work? And how do you want to execute, especially in the mid and small cap space, over next, say, 3-5 years?
Super question. Kamal, we have interacted multiple times through webinar. Maybe for many viewers, it might be first time, I don't know. We all know very well that our USP of AlfAccurate Advisors PMS, our hallmark, is discipline exit strategy. What to buy, everybody knows. If you ask in this forum, probably there are 200 participants, and if you ask each one of them, please give me one stock, there, each one of them can give you one stock. We can create 200 stocks portfolio right now. But the question is when to get out of it. And that's basically where the fund management skills comes into play. The fun is not in what you are buying. That of course we do. With the 28 years of individual experience, with 80 years of combined experience, we know we will not make blunder. God has been kind. In the last 13 years, there are 0 accidents in my portfolio. We know what to buy. But please tell me when to get out of it. And that's basically our USP. We have three reasons to exit. One is a portfolio rebalancing. We do not allow a stock to cross a particular weightage. Very important. By doing that, we make sure that if any unforeseen circumstances impacts our company, stock price and or earnings, we do not have that excess weightage, correct? Because we believed in strong diversification. As I said, diversification is the only free lunch in equity market. Second, we exit when the target valuations are met. Say for example, 1.5 years back, we bought Sundaram Fasteners. And we made our money. The target, when we bought it, the stock was trading at 15 times price to earning multiple. And when we exited, stock became almost like 24 times price to earning multiple. We decided to exit the stock. So very important, target valuation, particularly relative valuation. If I'm selling something at 25 times compared to some other company which I thought is a better growth prospect or better valuations, I will switch to that company. For example, many companies in specialty chemical, we have exited because we got our money and we believe that from now on the growth is going to be limited in 1 or 2 or 3 of such companies. We have exited those companies. And third, we exit when we go wrong. Very important to understand. Fund manager is not God. There are internal factors, there are external factors for the company in which we have invested, which changes their growth. So if we have assumed, for example, 20% growth for one company, and tomorrow, because of whatever reasons, we believe that growth is going to be now only 12%, and not for 1 quarter, for 6 quarters, 2 years, better we exit out of it and buy something which is better. Correct? Let me give one example, live example. There is a company called Canfin Homes, which we have in our portfolio. Triple emerging giants I'm talking about. Pristine balance sheet, best of the positioning, and best of the growth. Everything is there. But the managing director, the CEO, decided to resign. Now that is, in many banks, very important. They are leadership-driven organization. They might have systems in place, it's a big organization, they are not dependent on one person, but yet, in banking, what matters is top to bottom. The top heavy is very important when it comes to risk management in a banking system. We exited Canfina, no emotions, because we are uncertain who will be the next CEO. Hypothetically, let's assume the next CEO is better than the one who has resigned. No worries, we can always buy back. In public equity market, we have got option of exit. That's the best part of public equity. If we do not exercise it prudently, we'll be foolish to be in public equity market. I strongly believe that exit is something which is most critical to make sure that we finally make money for investors. The only constant in the world is change. Now, there is nothing called blue chip. Today's blue chip can become tomorrow red chip. 75% of Sensex has changed in last 16 years. MTNL, DLF, Jaiprakash, Bhel, Century Textile, Lexo Pharma, they all were part of Sensex. Today they are no more. Many of these companies are down 90%. They were blue chip companies. Right now down 90%. Reliance Infra, Reliance Com, and many companies, MTNL, Bhel, many companies. Monopolies. Can you think of not having MTNL fixed line in 1992? You can't even think of it. But today, you no more need it. So there is nothing called permanent. There is one question I can see on the panel, and I would also like to answer that. That the question is, don't you think if a fund manager is diversified, it means a less conviction? Definitely not. Diversification doesn't mean less conviction. In fact, diversification allows you to participate in many more growth opportunities. I don't know how many of you are aware. Disney Studio, how many cartoons they create and how many become, the hallmark, which people remember. 1 out of 10,000. Every movie is not Bahubali movie. The producer has to produce 100 movies, out of them only one movie will become Bahubali. You don't know which one it will be. Your conviction is as on yesterday. Today, if the US FDA comes out with an import alert on a pharmaceutical company, the stock is down 40%. Company is the largest company in the country. In pharmaceutical, number one company. Few years back, US FDA came and gave an import alert. What happened to the conviction of the fund manager? Nothing. Stock is down 40%. Volkswagen Global, one auto emission norm scam. Stock is down 40%. What research a fund manager can do to check whether the engineer in Volkswagen will do emission norm scam? You can't. Beyond a point, you can't. You can't predict such event. The only constant is change. The governance risk, the business cycle risk, and the technology risk beyond a point are uncontrollable. I'm not talking about the regular balance sheet risk. That we can figure it out, we can do due diligence, that all one can do. But can you predict auto emission norm scam in a company which is number one in the world in automobile called Volkswagen? Can you predict the US FDA import alert for a pharmaceutical company? Can you predict that BlackBerry and Nokia, the technology leaders, become bankrupt? To be very frank, you can't predict. Because if you all would have predicted, तो NPA होता ही नहीं था system में. All bank loans would have been good loans only. Why there should be NPA? If you all can predict that. You can't predict. Correct? So, very important is that your conviction is there, but take a measurable approach. Diversification helps you to reduce the risk without compromising on the returns. I'm using this term. There is a myth that diversification only reduces risk. No, it not only reduces the risk, but it also gives opportunity to create higher alpha in your portfolio. And that's why our AAA IOP multi-cap PMS plan, 50 stocks diversified portfolio is 19% compounded in last 13 years and probably one of the top 5 performing PMS in the country. Got award from even, from your firm PMS AIF for 2 consecutive years. So exit strategy is something very, very important, and diversification allows you. You ask the right question, Kamal, that what if the investor comes and then investor is not exited? I mean, the fund manager is not exited from the company which was supposed to be high growth. But this risk is lesser because it is not 10% of the portfolio. Can 50 companies fund manager can go wrong? That's a due diligence investor must do before selecting a product. That whether my fund manager what is selecting, what is his investment philosophy, what is his investment style, whether he is attached by the emotions to his companies or not. That's very important. 50 stocks portfolio allows you to play across the opportunities. 50 stocks allows you that even if accident happens, you can absorb the accident because it's a 50 stocks portfolio. 50 stocks portfolio allows you to embrace the not only China plus one, but also Europe plus one. 50 stocks portfolio allows you to play growth across different sectors, whether it is an automobile, whether it is a specialty chemical, whether it is a consumer durable, whether it is a consumer discretionary, whether it is a technology, EV related technology, whether it is a technology product related technology, and many more such subsets. Because please remember, India is a 5,000 listed company and there are 550 companies universe. That's huge opportunity. Challenge, but an opportunity. We do not have one single company in India in chemical that by buying one chemical company, you can get 5 chemistries. We don't have BASF in India. Please understand, India is a capital-starved economy from last 50 years. If you want to buy fluorine chemistry, there are only 3 companies. If you want to buy rubber chemical, there is only 1 company. If you want to buy ATBS, there is only 1 company. If you want to buy pigments, there are only 2 companies. If you want to buy amines, there are only 2 companies. Now what do? You want to take a risk of buying 9% of one amine company with one single plant? Definitely you should not. Your conviction has no meaning. Because if the pollution control board puts notice on the plant tomorrow, the plant will get closed and stock will go down 50%. But if you buy 2% of amines, 2% of ATBS, 2% of pigments, 2% of fluorine, all of a sudden now we have 6 plants, 100 customers, 25 plus product application for each of the customer. And that gives you enough opportunity to play across the different management, across the different growth model with the common characteristics of market leadership, large profit size, debt-free balance sheet, high underlying return on net worth, and very important, superior earnings growth.
Absolutely well said, Rajesh. I also kind of firmly believe in diversification, especially in the space of mid and small caps. And now all the more in future because we are going to see, holistic growth, given that India's economy is kind of showing resilience. Absolutely, and in that context, maybe diversification may, lead to not just, fall in the risk attribute of the portfolio, but also at the same time maybe rise in the return attributes of the portfolio, because we are not talking about over diversification. We're talking about a rational, a logical diversification. And with this we come to an end. And thank you, everyone today for kind of joining us. We do such webinars every Friday, and all the more we are doing now webinars in the mid and small cap space because we also firmly believe that times ahead, are more kind of favoring mid and small caps, and our responsibility towards our investors is to bring those ethical, credible, successful fund managers who bring with them, a lot of experience, so that we hand over our money and our faith in those hands, which can actually multiply wealth for us. Because more than a fund manager kind of, doing his own art and science in terms of wealth creation, it is investors' conviction and temperament that matters to kind of sail through that period. And if you give money to those fund managers, on whom you believe in, that is where you are able to kind of sail through those times. And that is where we always talk about making informed, well-informed investment decisions. And that is the overall business model that we have built around PMS AIF investments. So I am signing off. This is Kamal Manocha from PMS AIF World. For any further questions, you can book calls with us. We have a team of great specialists who are out there passionate, for investors to help you build wealth over next decade. Thank you, everyone, and thank you, Rajesh, for your time today. Thank you.
Kamal. Thank you very much for a wonderful opportunity.
Pleasure.
Thank you.
It's my pleasure.